And I just kept thinking about them. God, you're helping him. It's amazing, to see how far this horse has come.
It's not easy, it's hard. We would rather starve than let our horses starve. We want the horses. We want to help them. We want to be able to make a difference in their lives.
The views and opinions expressed in this presentation are solely those of the presenter and do not necessarily reflect the official policy or position of Horse Plus Humane Society, the Full Circle of Life Network, or any of their employees or management. The information contained in this presentation is for general informational purposes only and does not constitute professional advice. Any reliance you place on such information is strictly at your own risk. We strongly encourage you to conduct your own independent research and seek professional advice as needed.
Her list of achievements, awards, and certificates are too long and extensive to share. And with over 10 years of county experience, she can answer any question you can pose to her after this meeting. Ladies and gentlemen, welcome Stephanie Brown.
Hello. Can everyone hear me?
Yeah.
Okay, great. So yes, my name is Stephanie Brown. Tasha and I work together very closely. She is the head of our tax department. I am the head of our finance department. So we're going to be going over some of the financial statements that led to the tax return that Tasha went over in her presentation. So the two of us work together quite a bit. If you have the black portfolio that she used in her presentation, you'll see a set of financial statements in those that will help you a little bit with this presentation. So about me, I do specialize in nonprofit accounting. It is slightly different than for-profit accounting. And I have been working for over a decade in a multi-million-dollar nonprofit entity. So the big, long, scary tax form that Tasha talked about, I used to do 9 of those every single year because we have multiple divisions. And I also worked in the scariest state, California, which does have extra returns just for funsies. So the biggest question I get when I do talks on nonprofit accounting is, why does it really matter? After all, I filed my 501c3 if you're in the United States, or you became a registered charity if you're in Canada. So I'm tax exempt. It doesn't matter what I file. I made money, it's tax-free, right? However, one thing we need to realize, that makes you federally income tax exempt. That does not mean you are tax exempt from everything. You need to check with your state authority. Some of you will automatically be tax exempt in your states because your 501c3 transfers over. California, that's not the case. So you do have to file another form in that state. So just be aware to double check that you are registered in both entities. It's not an automatic registration. Additionally, there are other types of taxes besides income tax. If you sell things like merchandise, shirts, pens, mugs, books, anything of that nature, be careful because there are thresholds for sales tax. And your 501c3 may or may not cover you in your state, especially California, for instance. Sales tax is guaranteed in California. You cannot get out of it unless you are a reseller, meaning you're giving it to another store for them to sell it to the end user. So as a result, you want to double check with that. Employee taxes, stuff like income tax withholding. If you've got a full-time employee, you still have to file those things. You already have a question?
Yeah, I'm sorry.
I am on the first slide.
Do
we have
Mike and
one for him?
Need a mic for maybe Sal.
You want to hold the Russian shirt? Hold it.
Yours more.
It's okay.
It's a quick one, I promise.
It's all good. I'm used to this.
So if you live in a border town where you're bordering two states, is there a way to get state tax exemption in the other state?
Yes. So you can get tax exemption in multiple states. You just have to register in the multiple states. And you have to check the thresholds for what states. Some states won't care as much as others. Some say if you're physically in a different state and sell to my state, I don't care. Others will tell you that if you sell over $10,000, then I start to care. And if you're smaller than that, we'll leave you alone. Others say it's the threshold for number of transactions. And so if you do business in multiple states, it is a good idea to look into a tax software like Avalara to help you track the number of transactions in each state when you meet the threshold for that state, because they do keep up on all those regulations. For the most part, you should be okay, but it's something to keep in the back of your mind, especially as you grow, because I don't want you to get there, trip the threshold, and then have to go backwards. So I like to tell people when they're starting out, expecting it. And then the other big type of tax that we have to be careful for is unrelated business income tax. Tasha mentioned it in her presentation again, but it's so important that I want to bring it up again. You are only tax exempt for what directly relates to the mission of your organization. For all of you, that's rescuing horses. And you have to be careful, because the further you get away from that mission statement, the closer you are to owing taxes. And you're tax exempt for income tax. You are not tax exempt for unrelated business income. So one of the biggest areas I see nonprofits falling into this is actually YouTube monetization. It is a great technique, but it will trip you into an extra tax form. Now, as scary as that sounds, I can get you out of it as well. So it's one of those things where you have to file an extra piece of paper, but you don't have to owe tax on it because you're allowed to take expenses against it. So you need to track, if you're going to go that route, track your video production expenses. So that way when you get YouTube monetization, you say, hey, but it cost me $100,000 to produce those videos. Now your income is zero. Now you don't owe tax. But it's something to be aware of, because I don't want you to file your 990 without that, thinking all of my income is tax exempt. And then the IRS goes, hey, YouTube told us that they sent you money. Why didn't you put it on your form? So it's something to be aware of, because finding those receipts after the fact is more difficult than being aware and planning for that as you ramp up to it, especially until you meet the YouTube threshold to actually start making money on it. So the goals of this presentation, we're going to go through the two most important financial statements for nonprofits and hopefully get you a better understanding of how they work. Yeah. So the first financial statement we want to look at is the statement of financial position. If you have any experience in for-profit accounting, you're probably used to calling this the balance sheet. It comes from the accounting ratio and equation that says assets equals liability plus owner's equity for a for-profit company. And so because it balances, they call it the balance sheet. A statement of financial position is very, very similar. The difference is you don't have equity in the company because you don't own a nonprofit. You work for it, it has a mission, but you don't actually own it. So as a result, we call it the statement of financial position, and it looks at the health of your nonprofit at a certain given time and date. So their first section is called assets. This is everything your organization owns. And one thing I want to be careful to point out is this is what is in the name of the nonprofit. If you have accounts that are in your personal name, they should not be showing up here because they're not owned by the nonprofit. So be careful of that. It's easy when you're first setting up any organization to run some transactions through your personal accounts that are technically business related, and it can be done, it's not impossible, but just be really careful of that. As much as possible, we want to separate the two books. So you want to list out anything the business owns. This could be cash, if anyone owes you money, accounts receivable, inventory, if you're selling t-shirts and things, those t-shirts do belong to the company till you sell them and should be on your books. It's also going to be property, equipment, if you own a truck, if you own everything from the land to the barn, all those type of things that are in the name of the nonprofit should show up. The second part is the liabilities. This is anything the organization owes. If you've got bills that you need to pay back later, those would be your accounts payable. If you have a short-term loan to pull out to help you cover expenses in a short period of time, if you've got credit cards, if you have a mortgage on a property, all those type of things are what you owe to other people. And then the difference between these two things is the financial health of a company called the net assets. So hopefully what the organization owns is bigger than what they owe back to other people. And that net assets is what's showing you health. Yeah. So the second most important statement is the statement of activity. This is similar to an income statement. The difference being is you really don't have income as a nonprofit. You have donations, you have revenue, but you're not really generating profit per se. So this one shows revenues and expenses over a period of time, and then it shows the difference in the net assets from the prior statement. So there's several types of revenues you can have. You can have contributions and donations, and this can be broken down into multiple parts. So we have unrestricted donations. These are things that people give you out of the goodness of their heart with no limitation. I'm giving you $10, so you can do anything you need to it, whether it's helping a horse, paying the electric bill, buying horse food, whatever you need. Anything, open-ended. This is typically what you're looking for because you have the flexibility in what to do with it. Second type is temporarily restricted donations. So these are things that have to be held in place until a certain activity is performed. So a donor could give you a check for $1,000 and say, but you can only use it if you buy a new truck. So you have to put it in an account and leave it there until you buy a new truck. You cannot use it to pay the electric bill. You cannot use it to buy a horse. You cannot use it to feed a horse. It can only be used to get a truck, which is why I'm gonna give you 2 golden words that you want to make sure when you're doing appeals to help keep you out of this. You want to use words like and such as much as you can. And I'll give you an example of what I mean. If I say, I need help to rescue a horse named Dolly, and I get donations under this appeal with a memo that says, help Dolly, that's now restricted to only Dolly. And if you have more money than what you need for Dolly because you adopt her quickly and you don't have as many expenses as a long-term horse, now all those donations are now restricted and you can't use it until you get another horse named Dolly. So if I does come up and tell you, help me save horses like Dolly, 1 word difference in my sentence, but now I can use it for any horse because it's just someone like Dolly. And you might go, wow, that's a really tiny difference, Stephanie. And I can tell you a really big organization made this mistake. Who knows Shamu? Yeah. Yeah, SeaWorld's killer whale. They made this mistake. SeaWorld, huge rescue company, right? So they did a huge fundraising program that asked for donations to take care of Shamu, restricting it to just Shamu. What happens when Shamu is no longer with us? We now have a new killer whale named Shamu. It's actually Shamu the 4th or 5th now. And they did eventually correct the mistake and start saying like, help us save the whales. So now it's any whale. And it keeps it more generic. So when you're doing appeals and you're needing help with a certain project, it's okay. Just make sure to add the caveat in there to loosen it up a little bit for you so that you can use it for what you need. And so using like and such as is a really big help towards that goal, leaving it not quite as restricted. Now, one of the big things I wanted to point out, and this is an internal statistic I have from my career, So you can't Google me and double check me. But from the company I worked for, huge company, but we had 9 subsidiaries. Some of them were really small. Some of them were really big. And we wanted to know why the large organizations got large donations. And I'm talking to people who lay down 10 grand, 20 grand, 100 grand. Why did the bigger organizations get them and not our smaller ones, even if their advertising was the same? Because as one company, we had the same marketing team. So all the stuff was the same. What's the difference? And we noticed a really big trend. We did a poll among our own donors, and we asked them, because we noticed a trend, and we asked them, are you willing to give an unrestricted large donation? And 60% of them told us no. The large donors wanted to give to a specific project. So what they were wanting is to set up one of these temporarily restricted donations. When it kind of makes sense. If you're looking at an investment opportunity, do you want to just throw $100,000 at somebody and say, do something with it? Or do you want to know the plans and the restrictions of what they're going to do with this money? So I really recommend that on your website you have at least one restricted opportunity for donors. And I know a couple of you are looking at me and going, Stephanie, you just told me to be careful at restricted donations, and now you're going back on your word and saying I have to. Again, everything is in wording. So do not put on your website, donate to the truck fund. Because if you get $100,000 of truck, do you really need 4 or 5 trucks right now? Maybe, maybe not. Maybe you're really desperate for a scale or vet equipment. And so now you're stuck with money that's really close to what you want. So if you instead tell your donors what you want up front and word it in such a way that helps you, it can be really beneficial. Instead, say, help our equipment fund. Now you can do anything you want. You can buy a truck, you can buy a scale, and that donor still feels good because they know that they're giving within a boundary. You can't use it on just anything. We're narrowing it down to specific equipment for the horse. And I know each of you with your boards can sit down and look at your list of needs and find a nice general category to help try to foster some of the donors that are a little more hesitant. You still definitely want to go after donors that are the smaller Facebook donors that are $5 or $10, because those end up being your daily expenses. But having at least one option for a temporarily restricted donation fund can really help you get some of the big donors and get you some of the bigger projects that you're needing. And again, when you post this on your social media, say like, hey, we really need a truck. Please donate to our equipment fund. And now I've taken a very specific request and had them donate to a general fund. It works very well to help that. There's a third type of donation. These are permanently restricted donations. I don't really think many of you will get into these, but this is when somebody wants to leave like an endowment type of thing. So they'll give you a $200,000 check. They'll tell you, put it in an investment account, and any interest that's earned on that investment you can use. But you're never allowed to touch the original donation. You can only spend what is earned off of it. So I don't think a lot of you will get into that, but I want you to be aware that those do exist. So if you have a donor come up and say, I want to do an endowment, you're not like, what are you talking about? Yeah. So those are the 3 big types of donations. And then we have specific donations. So gift in kind. Anyone ever had some of these? I know we got one question about it. So gift in kind is when somebody gives you something other than cash. They can donate you a car, they could donate hay, they could donate jewelry, and they do have a lot of benefit to you as an organization. Now there's a couple things I want you to be aware of so that you do this smartly. One, it does require 2 extra tax forms. It does require an 8283 and an 8282 when you sell that item, because you have to track the original value so that they can get a tax deduction for it. And then you have to record how much you sold it for so the IRS knows what that gain was. So if you don't want to have the extra forms, one thing I recommend to people is to have someone else sell it for you. So for instance, A donor comes to you and they say, hey, I have a lot of this antique jewelry. My grandma passed away. I don't want it. Not my taste. I would like to give it to your organization. You can sell it. Use the profits to save horses. Great idea. I would ask them very kindly, can you take it to a jewelry dealer, have him appraise and sell it for you, and give me the cash? Now the jewelry dealer has to deal with all the tax forms. You get the money and you can use it. So a lot of people just don't know that that's an option. You will still have donors who want you to do it for them, and that's okay. But you will have to file the 2 extra tax forms. Just be aware of that. Yes.
Do those forms have to be?
Hold it. We should just leave him the mics.
So bad.
No, you're great. Questions are always good.
So if you're filling out a postcard form and you're below a $50,000 minimum, do you still have to fill out those forms?
I believe you do, because it's the only way that the donor can get the tax deduction. Yeah. So it's something to be aware of in case you get put in that position, because most donors that have the really high value stuff, there's also a threshold. I don't know if Tasha remembers it. It might be 500. So if it's less than that, you don't have to worry about it. And 5,000 for the bottom mesh. See, tax fight. We also have something called donor advised funds. Tasha talked about this a little bit on the 990. On the very bottom, there's a question about this. Donor advised funds are really interesting. You can donate to a nonprofit and get a tax deduction for the full amount up front. So they can give you $100,000. But you can't use the money. They get to tell you how to use it later. So usually once a year, right before the end of the year, they'll come to you and say, hey, I want to tap into my donor advised fund. You can cut yourself a check for $5,000, but I also want you to send a $5,000 check to XYZ church. It has to be another nonprofit organization, but you aren't guaranteed to get all the money like you are with a restricted donation. If somebody asks you for a donor advised fund, I don't recommend them because you can do a lot of work and actually get none of the money. Hopefully you have a donor that cares about you and they are going to give you all the money over a period of time. The really good donors will say, hey, I'm going to give you $200,000 now. I need the tax deduction, but you can have $20,000 every year. And so you just release part of it to yourself, and that's really good. But you want to talk to your donors before accepting these just blankly. I know a lot of times as a nonprofit, you are desperately wanting donations. And so the impulse is just like, yes, help me. And then you end up getting into a situation where you have money you can't use. So just watch out with these. They can be really beneficial. They can also be really annoying. So it just depends on your donor and what they want to do. And then the last thing I wanted to touch on is called allocated funds. So this term gets mixed up with restricted funds a lot because they sound similar. I'm giving money to a specific purpose. The difference being is a restricted fund is done by the donor's discretion. The donor is the one saying this needs to get used for equipment. An allocated fund is done by board discretion. So if you have a year with a lot of surplus and you want to save for the future, you can allocate some of the surplus and say, we're going to put this money in a reserve account for a future year when we have a net loss. Or we know that we're in desperate need of more lamps, so we're about to do a large land purchase. And I know that it's going to send my statement of financial position and my statement of activity negative for the year because it's so much money up front to do a land purchase or like a building purchase. That's a lot of money up front. Helps the organization over time, but in that 1 year, it hurts you really bad. So you can do an allocation in a prior year and then release those funds in the next year when you actually have the purchase to help make it look better for your board members, especially because we recommend your board be made up of people who have skill sets you don't have. It's not as helpful to have a board full of people who have the same point of view as you. While it's nice because they agree with you all the time, it's not really accomplishing the purpose. The purpose is to guide you in the areas you don't know. So as a result, you may end up with people on your board who are used to for-profit statements. And if they see a net loss, they're like, oh no, what happened? This is really bad. For nonprofits, it's not necessarily bad to have a net loss every now and then. It means your mission was driving harder than your donations was, and you need to fix it eventually. But 1 year or even 1 month, if you're doing monthly statements, isn't the worst thing in the world. It's not the same as for a for-profit company. So doing allocations is a nice way of calming down those board members that might be from a more corporate setting, so that they know that you're not just spending a bunch of money just for fun and without counting your cost. Sorry, my thumb keeps closing. Okay, so we have a couple other types of donations. We have grants. These can be really great. I always recommend searching what grants are available in your area. You would be surprised how much money is sitting around that nobody taps into because some donor set up a grant idea and nobody bothered to apply. And it's actually really sad. And it can be scary because as a small nonprofit, you're like, oh, there's gonna be 100 applicants for this, and I'm gonna be put on the bottom of the pile. I'm too small. I shouldn't even bother to try. Always try if you can. I know it takes a little bit of your time, but if you've got the time, apply. You could be the only applicant. You could get the money almost guaranteed. You don't know until you try. And then you have program service fees. These would be things that you're charging your services for. That would be part of the surrender fees that Tawnee's been talking about. So they're technically not a tax deductible donation because they're getting something out of it. You're taking care of their horse, so it's not quite the same as a donation. So you could consider that a service fee. And then your investment income. If you've got any money in a bank account and it's earning interest, that needs to get reported. And now we have expenses. Yes, I'm sorry. The lights are really bright. Right here.
Yeah, thank you.
Program services, does that include adoption fees too?
Probably.
It could.
Yeah.
You'd be receiving a horse right?
Yep, right. Yeah. Yep, definitely. So be careful. Anything, and this is actually a good point to bring up. So anytime that somebody receives a benefit from your company, they can't get a tax deductible receipt. Now there is an exception because good old IRS, there's always an exception to the rule. If their gift they receive is less than $12, and yes, I know, very random amount. I love it. It went up from $10 2 years ago. So yeah, inflation. Woo-hoo. If it's less than $12, meaning you're giving them a book or a pen as a thank you gift for a donation, you can give them a receipt for the difference between their donation and the value of the item. But I will caveat that with, it cannot be an item that is sold. So I know a common thing to do is we're gonna print all these shirts with our logo on them. We're gonna sell them because it's great brand advertising and an income revenue stream, right? Great idea. The problem being is sometimes then we're like, we got a really high donor, we're gonna give them a shirt and send it in the mail. If your shirt is over $12, or actually even if it's under $12, because that shirt is sold, it does not follow the exemption rule. So you have to deduct it from the donation value. So it's something to be aware of. So if somebody gives you $100 and you give them a $10 shirt and that shirt is sold, they only get a receipt for $90. That shirt has to get taken out as if they purchased it. Now you can do it at the cost of the shirt, not the sales price. So if you do a sales price for $25, you don't have to deduct $25. You're doing the cost of it from the printer. But if it's under $12, they can get the full donation value as long as it's not sold. And I probably confused you all. That makes sense. I know it's a tricky rule. It's not my favorite IRS rule that ever existed. And since it's a weird dollar amount, it's weird. But yeah, anytime that they are getting a benefit from what they are giving, do not give them a tax deductible receipt for it. Because they are receiving something in return, technically it's like a sale. So expenses. Now here's something that most of you are probably not thinking about. A lot of you have the 990 postcard or the 990 easy, and that form is far, far, far easier than the full 990. When you get to the full 990, you are required to have your expenses in categories. They cannot be randomly thrown on there as just electricity. This is just water. They have to be categorized into these 3 categories. So I recommend to people that even though you're small right now, set it up from the beginning as if you were going to become a big organization one day. Because that's the hope. You plan on growing. You don't plan on staying small forever, most likely. So as a result, you want to set yourself up for success and start categorizing these things. So I want to explain them to you. Program expenses are anything directly related to the mission of the organization specifically. So your horse food, the expenses of auctioning and purchasing a horse or rescuing it, all of those are going to be your program expenses. Admin, on the other hand, is anything that's generic to the organization as a whole. So this is going to be your electric bill, your water bill. Yes, those things are connected to your horse barn most likely, or you're giving water to the horses and giving them light over their head, but it's also probably in your home or in your office, in a different building. So it's covering the organization as a whole. Those are your administration costs. Any employee salaries, if they're doing anything for the whole organization, they work on financial statements, they work on office paperwork, they are an admin employee. Yes.
So, say you have a solar system that powers the entire property. As the owner of the solar system, and it was personally bought, can I deduct an administrative expense on my taxes as a charitable contribution?
That's a great question for Tosh. So in other words, you would have to look at what the electricity bill would be if you didn't have the solar panels, how much of that electricity would be used by the nonprofit organization. Donate that value to the organization, find a third party that is willing to sign off that that is the value of what that is worth. They have to sign the bottom of the form, and then absolutely.
So can you do with property taxes and everything else as well? If the property is part of the residue?
Okay, hold on. I'm going to take this micro.
So if you are paying for stuff that the organization is using, then there's only 2 types of donations you can make to an organization: cash and non-cash. Non-cash is for that 8283 form to take effect is anything over $500. So property taxes. This one gets tricky because the question would be, does any of that property used by you personally? If all of it is used by the organization, then the whole thing could be an 8283 non-cash donation to the organization. If you use part of that property for yourself for other reasons, business purposes, it might need to be prorating between all the other reasons that you are using it for as well.
Which is one of the reasons I was saying, be careful of those non-cash donations. As much as you can, and we did have a question on this, donate cash to the organization and then have them pay you back. It's actually easier because that form has to get signed by a verified third party, and to find an expert in that specific field that's willing to swear that that's the correct valuation is difficult on many items. The most common ones I see are going to be cars, jewelry, coins. Those are types of things that people often collect and can get appraised fairly easily because there's brokers in those items. Stuff like property taxes and electric panels. And I can't really think of an electric expert other than the power company. And I don't know that they're going to send one for you. Maybe. You can ask. I did say it was always worth asking, but it will be more of a challenge. So administrative expenses are all of your overhead type of things. Even if you don't rescue a horse this month, these are the expenses that you will still have regardless, would be one way to think of it. And then lastly, your fundraising expenses. Anything you do to promote the mission of your organization gets tracked separately. They want it reported separately. And one of the reasons that it's important to know this is 990s are publicly available for people to look at. Most common is GuideStar. You can look up and see your own 990 there. There are donors who comb through GuideStar looking for organizations that are deserving of donations. And I don't think with the postcard, but with Easy and the full 990, I know that they'll go through and they'll read your program descriptions. And they will see how much of your money is program versus admin. So you want to be careful and think about this. If you're looking and your admin is out of this world and your program is really low, it means that your mission is not really running as well as it could be, and they're not going to give it to you as much. And this is a sad side effect of some of the organizations that you've heard in the news lately, that we found out the CEO of the nonprofit is making all of this money, and all of this money we thought was going to save the pandas in the rainforest isn't going there. And it's why they started making these categories, so they can see that admin, the CEO's salary, is 50% or higher than the program. And honestly, most of your expenses should be program in one way or another, because that's the whole point of your here. If you don't have program expenses, why are you a nonprofit? Is going to be the initial question. So to start looking at this and categorizing things this way will start helping you get donors, because those donors with the trickier questions are more likely to give to you if they see that your program expenses are higher than your admin. And you can say, hey, out of every dollar you give me, 75 cents goes directly to a horse. That's a really great marketing tool. You have a question?
Okay, so I'm looking into getting my QuickBooks for my expenses and stuff like that. Do you know in QuickBooks then, can you actually categorize this? So if I put in fee, can I put in program expenses so that at the end of the year, I just have that number?
Yes, so in QuickBooks, when you set up accounts, great question, you can set up sub-accounts. So you want to have the 3 accounts of your nonprofit books be program, admin, fundraising, and everything is a sub-account of one of the 3. It may result in you having 2 accounts with the same name if you do have something where you have salaries that are programmed. If somebody works only in the horse barn directly with the horses and never does anything else, that's a program expense. So you might need to have salaries and wages dash program, and then you might have admin for your CEO or whomever, and you might need to have salaries and wages dash admin.
Okay.
But that's the way, so then you have 3 groupings on your statements.
Now I'll have to dig through. Okay, awesome, thank you.
Yeah. And it's one of those things, I don't want anyone to feel like, oh, I heard the presentation and I found out I'm doing my books completely wrong. No. Your books are simple right now because you are a small organization. Do not feel like you have to go home and fully renovate your books so that you can operate as a full 990 organization. I'm giving you the tips and tricks to slowly work yourself up there. That way, once you cross the threshold to the full 990, you're like, I'm ready, I got this. Because over time, I slowly worked myself there. So it might be you go home and you print out your financial statement and you just start marking, I think this is an admin. I think this is a program. And then once you have it all down, you spend an hour one day, rework it, and you're there. Don't feel like you have to jump there right now. Notice that the financial statements in your packet are simple. These 3 things are not on them. Why? Because the organization we picked was a 990 easy. It's not required. So this would be one of those organizations that I'm going to start working on that, so when they're ready for it, they're prepared. But it's not going to be as instantaneous, I have to suddenly hit all these check marks. At least that was my goal, is to give you the tools so when you need them, you already know how to use them. So the difference between our revenue and expenses is called our net gain and loss. And that's basically the financial health. You always want to be positive. Some years you might have a purposeful negative though. And I don't want you to feel like it always has to be positive. This is not a for-profit entity. If you purposely spent a lot of money this year on a big purchase, it's okay to have a loss. I would just say that you want to have a note of reason, so when you talk to your board, They're going, hey, what's causing the net loss? Are we worried about the company? Are we not fundraising enough? Or did we have a purposeful big expense? Now this also refers back to your statement of financial position, because the change in net assets from this form should equal the net assets from the prior form. And so they are related. So that's basically the end of my presentation. There was only one other thing that didn't really fit anywhere good for a slide, and that was to remind you about 1099s. So at least one person was asking us in between meetings about, hey, what qualifies for a 1099? So I thought all of you would probably benefit from this reminder. If you have anyone do labor for your entity, before you pay them, please ask for a W-9. This is a form that's asking for their information as a business or even as an individual. That way you can give them a 1099 at the end of the year. I want you to compare this to an employee. If any of you have ever had a regular corporate job, when you started your job, you filled out your I-9. At the end of the year, you got your W-2 and W-4 for your taxes. This is the same thing. Even though they are not employed by your organization and they are doing a specific job for you, they still have to do their taxes at the end of the year, and to help them with this, you need to track how much you paid them. And I get the question a lot of, well, the threshold is $600. Yes, but in January 1st, how do you know how many times you're gonna use that individual? You may spend $550 in January and be like, I'm done, I'm never gonna use them again. On December 31st, all of a sudden you need them. Are you gonna delay treatment of whatever problem you have until the next year rolls around so you can stay under threshold? Additionally, I tell you to get it anyways because it helps weed out some of the bad contractors. If they're not willing to give you their W-9 information, chances are there's something sketchy going on. They're trying to avoid the IRS. They could be using a false identity. And so you don't want to get involved with that. It can come back to bite you. If they're willing to fill out their W-9, chances are they're a good contractor for you to have. So I always recommend getting your W-9, and that way you're ready. If at the end of the year that person's under 600, great, you don't have to give them a 1099. Don't worry about it. But if you are over, you have it at the beginning. Additionally, I recommend doing it before you pay them the first time, because once that person is paid, tracking them back down is almost impossible. And so getting it in the beginning makes your life a lot easier. If you do pay them a second time and you don't have a W-9, I always recommend printing out a physical check, having them come get it, and saying, if you want the money, sign the form. There is a IRS requirement that they give you this information. So if you do have somebody that's refusing to fill it out, you can be like, so I can turn you into the IRS and you can get $500 if you'd rather. And if you don't have the paperwork, you're actually required to do withholding on them like they are an employee and turn it into the IRS. So something to be aware of. I know it's a common question. There are a lot of rules and regulations as to what an independent contractor technically is. So you want to look those up and double check. But the good rule of thumb is, did they do physical labor for your company? And if they're using their personal name, almost guaranteed that they need a 1099. A lot of them, if they have a business name, end up having like a corporation status that doesn't require it because they're running their own business and running their own financial statements. Did you have a comment on this, Tasha?
No, when you're done, I was going to come home and pinch me.
Okay, I'm done.
Thank you, Stephanie. I love working with her because I have a lot of information in my head, but I don't have all her information in my head. She's got a whole different set than I do, so that's pretty awesome. So if you were wanting to talk to us, I know that we're running out of days on being able to talk to us, and maybe later on you may have some questions. How do you go about talking to us later on? There is in your packet, there is my business card, And if you don't have one in your packet, I can also get you another business card. And I believe Stephanie has her business cards with her. She's head of the Office of Finance, which would be the accounting department. I'm head of the tax department. Closer, got it. And you can email either one of us and set up a Zoom call consultation with us. We can go through your details, we can ask you questions, and we can give you recommendations on best practices. And we have many other departments you might be interested in. At some point, you may need an audit. We have audit partners. You might need, we have a marketing section and marketing partners. We have capital funding, and we have data analytics. And so if you're interested in any of those departments, let us know and we can get you to the right person with that as well. But that's how you speak to us later on if you would like to. Thank you.
Good.